Today I would like to analyze Arista Networks, a leading provider of cloud networking solutions for data center and AI infrastructure. If we take a look at the stock price, we are up 540% in the 5-year charts. This is an incredible performance, and we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 109.6 billion US dollar. This makes Arista Networks the 43rd largest technology company in the world by the market cap. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. In 2020, the revenue was around 2.3 billion US dollar. This was a 4% decline from 2019. In 2021, we saw the strong growth around 27%. Then in 2022, we saw the incredible growth around 48%. In 2023, we saw the strong growth again around 33%. And then in 2024, around 20% growth. So in the last 5 years, we had an incredible growth. So the check here. The next thing we're looking for is free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 0.72 billion US dollar. This was a 24% decrease from 2019. Then in 2021, we had the comeback with a growth around 32%. In 2022, we had the decline around 52% again. Then we had the strong comeback in 2023 with a strong growth around 346%, and this continued in 2024 with a growth around 83%. So it's also a check here. We had a good free cash flow growth in the last 5 years. It was a little bit inconsistent, but still a good growth. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024. This is around 3.68 billion. We're going to divide it with the current market cap, 109.6 billion. So then we're going to get the free cash flow yield for 2024. So the number we're going to get would be around 3.35%. So I think this is a decent number actually. Yes, it's under 4%, but we can also expect this company to continue to grow the free cash flow. So we're going to take a look at the future free cash flow as well. If we ask ChatGPT about future assumptions of the free cash flow, we can see here in 2027, we could reach around 4.9 billion US dollar. So let me know in the comment if you think this number is realistic. So we're going to take this 4.9. We're going to divide it with the current market cap, 109.6 billion. So then we're going to get a free cash flow yield for 2027, 4.47%. So this number would look already better with our future free cash flow assumptions. It would be over 4%. And I think this is something we like to see. This could be a good valuation. The next thing we're looking for is the debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here around 37.5 million US dollar. So let's calculate it here, 0.04. Then we're going to add the short-term debt as well. We can see here around 0.22. So 0.02 billion US dollar. Then we're going to divide it with the current free cash flow, 3.68 billion. So then we're going to get the debt to free cash flow ratio for 2024. So the number we're going to get would be around 0.016. So this is a very low number. It doesn't take many months to pay back the debt with the free cash flow. So we like to see that is a check here. We can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 8.3 billion US dollar. This is a huge amount actually. This is close to 10% of the market cap. So we like to see that this company has an incredible balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. This is the current market cap, 109.6 billion. We're going to add the debt. So the debt's around 0.06 billion. We're going to take minus the cash. This was 8.3 billion. So then we're going to get the enterprise valuation, how much the whole company is worth. So the number we're gonna get would be around 101.36 billion. So now we're gonna divide with the current free cash flow, 3.68 billion. Then we're gonna get the ratio that we're looking for. The number we get is around 27.54. So I think this is a decent number. Of course, we're looking for a number under 25, but this company can also grow the free cash flow a lot. So I think it's still a good number. We can calculate this number for 2027 with the free cash flow assumptions of 4.9 billion. Then we're going to get a different number. So the number we're going to get would be around 20.68. So this number would look even better. And of course, if this company can continue to grow the free cash flow even after 2027, this valuation would be even more undervalued. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. We can see here repurchase of common stocks. So yes, this company buys back their own shares. But if we take a look at the shares outstanding, we can see here it increased over the years. So this means the company has a stock-based compensation, so they pay the employee with shares for their good work. This is normal, especially for technology companies, but is somehow a hidden cost as well, because it's not taken from the free cash flow. This is just increasing the shares outstanding, so it's not a check here with the shares outstanding decrease over the 5 years. Is Arista Networks stocks a good buy right now? So let's start with a positive. So we had a good revenue growth in the last 5 years. We also had a good free cash flow growth as well. This is something we really like to see. The balance sheet is also looking great. This means a low amount of debt and a good amount of cash on hand. The free cash flow yield around 3.35% is also looking decent for a technology company. With our free cash flow assumptions for 2027, this number would be around 4.47%, which would look quite good. The enterprise valuation to free cash flow ratio around 27.54 is also quite decent. With our free cash flow assumptions for 2027, it would be around 20.68. So yes, this company does look undervalued with our free cash flow assumptions in the future, but something we also need to consider is the shares outstanding increase. So this means the company puts more shares on the stock market, and the main reason for that is the stock-based compensation. So they pay the employee with the stocks. So this is something we need to consider as well, because it's a hidden cost. I think this company can still be a good buy right now, but only if this company can continue to grow the free cash flow in the next 10 years around 10 to 15% every year. If you found this video helpful, don't forget to like and comment and subscribe for more content.